Okay, so Johnson & Johnson's star drug Stelara basically fell off a cliff this quarter. I mean, sales evaporated by nearly 62%, yet the rest of the portfolio somehow just put up double-digit growth.
It really is wild. If you just glance at the headline numbers, you'd think the core business was actually collapsing. The bottom line dropped 52% year over year, but it's almost entirely an accounting illusion.
Which is exactly why we have jobs. Welcome to Earnings Unscripted, where we try to find the actual truth in the filings. Today, we are digging into the grandfather of healthcare, Johnson & Johnson, ticker JNJ, for their first quarter of 2026. It is April 14th, 2026. And a quick reminder before we dive in, we are just two friends chatting, so this is definitely not financial advice, just our own personal takes.
Right. And honestly, the market eventually figured out the illusion too. Pre-market was pretty ugly. The stock dropped near 234. But as soon as the regular session opened, it just climbed steadily all day, closed up 0.86%.
So let's talk about what fueled that recovery. They pulled in $24.06 billion in revenue. That is up roughly 10% year over year. Adjusted earnings were $2.70 a share, but you mentioned that massive 52% cratering in GAAP net income, down to $5.23 billion.
Yeah, the ghost of courtrooms past.
Exactly. What actually caused that?
So it is purely a base year distortion. Exactly 1 year ago in Q1 2025, they booked this massive $7 billion favorable reversal for a talc settlement accrual.
Oh, wow.
Yeah, so you stick $7 billion on the books last year, and suddenly this year's perfectly normal quarter looks terrifying by comparison. If you strip that out, their operational adjusted EPS only dipped 2.5%.
Okay, that makes so much more sense because operationally they are clearly executing on the pharmaceutical side. Innovative medicine grew over 11%. And I saw this incredible anecdote from the call about their new plaque psoriasis pill, eclipse.
The March approval, yeah.
Right. Their commercial execution was so aggressive that the first actual patient received the medication within 24 hours of the FDA approval.
That is just serious muscle. You almost never see launch logistics move that fast in healthcare.
I know. They wrote 1,500 prescriptions basically instantly. But obviously, moving that fast is not cheap.
No, it really isn't. And that shows up clearly in the margins. Adjusted pre-tax margins fell 410 basis points to 32.5%. And free cash flow, this is the one that really stood out. It plummeted 55% year over year, down to just $1.5 billion.
Wait, $1.5 billion for J&J? That seems remarkably low for them.
Well, management preemptively flagged it. It's a squeeze from front-loaded investments. They're shifting the timing for U.S. rebate payments, and they're spending heavily right now on that huge $55 billion domestic manufacturing commitment they promised.
Got it. So they're bleeding cash today to build out the moat for tomorrow. All right, let's get into the details and see if that capital allocation is actually paying off.
It really is paying off if you look at where they're actually deploying it. I mean, if you dig into the medtech segment, specifically cardiovascular, the strategy there is fascinating right now. They acquired Shockwave a little while back, and that gave them basically a total monopoly in intravascular lithotripsy.
Right. That is the technology that uses sonic pressure waves to break up calcified plaque in arteries.
Exactly. But now the moat is finally getting tested. Other companies are just now getting regulatory approvals to enter that market with their own first-generation devices.
So you would naturally expect the classic response then. Defend market share, lower the price, and prepare for margin compression.
No, but that is the genius here. They are running entirely away from the price war. I was reading the transcript, and the CEO laid out this brutal counterpivot. Let me actually quote this. He said, "While competitors are introducing similar versions to our first-generation products from 2017, we are introducing our fifth-generation coronary and peripheral devices in 2026.
Oh, wow. That is almost arrogant. So they're basically letting rivals compete against a ghost.
Yeah, it's just classic tech hardware obsolescence, but applied to cardiology. You arrive at the battlefield to fight their product, and they're already selling a tool that makes your new device look like an antique.
That is such an elegant way to avoid a race to the bottom. But, okay, zooming out, that level of portfolio cycling takes an enormous amount of cash.
It does. You can't jump to a fifth-generation device without massive R&D and manufacturing scale. And what makes it tougher this quarter is they're actively fighting macroeconomic drag at the same time.
You mean the tariffs?
Right, exactly. The VP of Investor Relations was completely transparent about it on the call. They noted that medtech margins were specifically pressured by the impact of tariffs deleveraging their cost of goods sold.
Do we have clarity on which trade corridors are actually causing that? Because I don't recall seeing a geographic breakdown in the filings.
I don't have the exact regional numbers handy, but it provides a very concrete example of macro trade policy literally chewing into healthcare gross margins in real time. And it is not their only regional headache. Management called out volume-based procurement in China as a major looming threat for the second half of 2026.
Ah, yes, the VBP system. That has been so punishing for medical device makers lately.
Yep. The government just bids in bulk to drastically slash prices. Management warned it is going to hit their electrophysiology products especially hard.
Okay, so on one hand, you have this brilliant Shockwave defense strategy. On the other hand, you have global tariffs and Chinese price controls eating into the upside. It feels like a very delicate balancing act.
It really is. It is a control system running right near the red line.
Well, I want to inject just a quick bit of human reality before we move on, because we talk so much about VBP and financial engineering, but you really have to step back and look at what the technology actually achieves. Did you see the clinical data they dropped on the Impella heart device?
The Danger shock trial. I did, yes.
It is genuinely staggering. They tracked patients having severe STEMI heart attacks complicated by cardiogenic shock, and routine use of the Impella pump led to a 16.3% absolute mortality reduction over 10 years compared to standard care.
Which is, that's a massive statistical delta in this field.
It really is. The executives pointed out it translates to an average of almost 2 extra years of life for these patients, roughly 600 extra days alive. That kind of metric completely recontextualizes things when we complain about margin pressure. They are building hardware that literally alters human longevity.
Yeah, that is entirely fair. It is easy to forget the actual utility of the capital when you're just modeling the cash flows.
Exactly. Okay, so putting the whole picture together, we have massive upfront investments, changing market dynamics, and actual shifts in the standard of care. Where does this leave them as a business heading into next quarter?
It leaves them with, honestly, zero room for error on the execution side. Because look, management just came out and explicitly raised their full-year operational sales guidance. They are projecting somewhere around the midpoint of $100.2 billion, which crosses that massive $100 billion threshold for the first time.
$100 billion. That is, that's a huge psychological milestone for them. But are they actually accelerating, or are they just leaning on that extra 53rd week in the accounting calendar they mentioned?
It is a bit of both. The accounting helps, sure, but the CEO actually got fairly defiant about the core momentum. Let me just find his exact phrasing. Right. Quote, "We are already delivering double-digit growth as total Johnson & Johnson when you exclude Stelara. It is already happening today." End quote.
Okay, already happening today. You do not usually hear that level of swagger from a Heritage Pharma executive.
No, you really don't, but they kind of have to be loud right now. They're preparing to spin off the orthopedics division to Pew Synthes next year, or, target is mid-2027, actually. So they desperately need the market completely bought into this high-growth narrative before they go through the headache of figuring out that separation vehicle.
Right, because restructuring costs are going to inevitably hit those margins again. And they still have that Chinese pricing lag waiting to hammer electrophysiology in the second half of the year.
Exactly. So the real metric to watch next quarter is not top-line revenue. It is the free cash flow. If that front-loaded U.S. capital spend does not start normalizing, or if those global tariffs bite harder than expected, that $100 billion victory lap is going to feel incredibly expensive.
It is wild. They're basically running the playbook of a hyper-aggressive tech stock, but trapped inside a blue-chip dividend body.
Optimism with a spreadsheet, remember? We will see if the math actually holds up in Q2.
We absolutely will. All right, that wraps up our look at JNJ for this quarter. Let's head to the close. All right, that is a wrap for us today. And if you like having these earnings chats to show up in your feed, feel free to follow the podcast. We actually put this together with a little bit of AI assistance, which is how we managed to compress hundreds of pages of regulatory filings into a quick 10-minute conversation. It is a really fun experiment, so please send your thoughts or ticker requests over to earningsunscripted@datamadness.ca. Or just hit the X link in our show notes.
Get you after the next bell.